Welcome to the training course, How to Construct an FX Hedging Program. FX risk management is one of the most important areas CFOs and treasurers must master if their business operates internationally. Many companies that do business with suppliers or clients overseas leave implementing risk management policies until they are forced to react by external events or stakeholders. Yet, a well-implemented hedging program that is aligned with a broader business strategy and understood both by the finance team and the wider organization can be instrumental in many ways. Good risk management can help drive faster and safer international growth, reduce the working capital burden, and create a competitive advantage in industries with profit margins under pressure. This module explains how you can proactively implement an FX hedging program in practice by understanding foreign currency exposures and risks, aligning the objectives, and putting necessary processes in place. It builds on the foundation discussed in our earlier module, FX Risk Management 101. Implementing a robust hedging program requires the input of different stakeholders. It covers areas ranging from setting up strategic objectives to deciding who will be doing what and how, to ensuring an ongoing monitoring and improvement process. This course will cover specific steps an organization may want to take when implementing an FX risk management policy. Step 1. Setting clear goals and risk tolerance. FX hedging is a specialist area that is often misunderstood and, as a result, underused by many businesses. One of the most common mistakes made by less experienced finance teams is implementing hedging strategies that are poorly aligned with the company's overall strategy and risk tolerance. Before diving into the practicalities of setting up a hedging program, it is critical to agree with the senior management and other key stakeholders on key principles that will anchor the rest of the program, its objectives, and risk tolerance. The objectives of your hedging program should be discussed with and approved by the senior management, such as company directors or the board. These objectives may vary depending on the type of business and the industry it operates in, and can include reducing transaction risk, protecting profit margins, or minimizing volatility in financial statements. For example, businesses that operate in e-commerce, wholesale, travel, or logistics often face narrow operating margins that can be easily eroded by currency fluctuations. Hedging the value of sales or purchase orders and invoices can remove FX risks from transactions with overseas supplies and buyers by converting specific future cash flows into your home currency at exchange rates secured in advance. Larger businesses that are publicly listed or have professional investors, such as VC and private equity funds, often face scrutiny about the effect that foreign currencies have on their free cash flows or periodic financial statements. Setting up a policy that removes such volatility is another common hedging objective, particularly for larger firms. Whether it is aggressive growth through the most competitive prices or optimizing profitability of specific transactions or projects, aligning objectives with overall business strategy can ensure your hedging program has the right impact. The second core principle for a hedging program is the overarching risk tolerance of your organization. No business operates at the extremes of the risk appetite. When it comes to foreign currency exposures, practically no one would willingly allow an unlimited currency exposure that can endanger their company. Conversely, very few businesses would dedicate resources to removing minor risks that don't have a material effect on their finances or operations. Hedging requires time from your finance team and can cost money, and setting the right risk tolerance will help strike the right balance between the costs of your hedging program and its benefits. Risk tolerance is the level of risk that an organization is willing to accept or endure before taking action to mitigate or manage that risk. It reflects the organization's willingness to bear uncertainty and potential losses in pursuit of its objectives. Risk tolerance is a high-level strategic consideration and sets the overarching framework for risk management. Step 2. Identify and classify risks. Strategic goals and risk tolerances that were agreed upon with senior management can be translated into practical types of exposures and risks. There are numerous ways that foreign currency fluctuations can impact one's finances and business overall. Hence, a hedging program can be designed to mitigate risks stemming from one or several types of currency exposure. The most common FX risk types include transaction, translation, operational, and economic risks. Transaction risk, also known as short-term FX risk, arises from the impact of exchange rate fluctuations on specific business transactions and certain parts of your balance sheet, for example, accounts payable or receivable in foreign currencies. It occurs when an organization has contractual commitments, such as sale or purchase contracts involving foreign currencies that will be settled in the future. The objective of removing the transaction risk is more certain revenues, costs, and profit margins from transactions that have already been entered into and will be settled in the future. Similarly to the above, translation risk affects the balance sheet of an international business, but it usually arises from consolidated financial statements of foreign subsidiaries or other assets and liabilities in foreign currencies. For example, a multinational corporation consolidates the financial statements of its foreign subsidiaries, and exchange rate swings can impact the reported value of these subsidiaries on the consolidated balance sheet. As it affects periodic financial statements, translation risk usually has a multi-month or multi-quarter time horizon. Managing both transaction and translation risks affect short-term financial results and balance sheet, and, as a consequence, they are usually covered by so-called balance sheet hedging programs. Operating FX risk refers to the impact of exchange rate fluctuations on the cash flows and profitability of a company's ongoing operations. It captures how medium-term changes in exchange rates can affect sales, costs, and margins, and make free cash flows more uncertain. Cash flow hedging, also known as forecasted transactions hedging, removes operating risks and helps remove the uncertainty caused by currency fluctuations from financial forecasts. It improves cash flow stability and allows businesses to better plan and allocate resources. Economic risk. Economic risks, also known as strategic FX risks, represent the potential impact of exchange rate movements on the overall economic value of a company. It is not tied to specific contracts or financial statements, but relates to the broader competitive position and cash flows of the business. For a variety of reasons, shorter-dated risks are easier to identify, quantify, manage, and account for. As a result, managing transaction and translation risks is the most popular, followed by cash flow hedging, which is more popular with larger corporations. Step 3. Aggregate exposures. Currency exposures need to be identified and quantified first in order to assess relevant risks. Determine which assets, liabilities, revenues, and expenses in your financial statements are exposed to currency risk. Next, quantify the exposure by each type and foreign currency. This involves assessing the monetary amounts or values associated with each item. For example, if you are dealing with transaction risks, the exposure can come from the contracted or invoiced value of your sales or purchases in foreign currencies. Creating a robust method that allows calculating foreign currency exposures in a frequent yet timely manner is a critical step in good FX risk management. Step 4. Quantify risks. Once currency exposures are identified, they need to be translated into FX risks. As currencies go up or down, balance sheet values, profit margins, or cash flows evolve differently than if you were doing business in one currency. Measuring risks focuses on probable negative outcomes from such fluctuations. Such probable negative outcomes are a function of the currency exposures and how much exchange rates could move while the exposure is outstanding. consider the timing and maturity. The longer the exposure period, the more currencies can move and the greater the risks. Looking at how much exchange rates moved in worse cases in the past is often a solid starting point for estimating the risk scenarios. A basic approach is to choose a uniform, large, but realistic size of an FX move across all currency pairs and rank them in terms of estimated likelihood for each pair. Some currency risks stemming from exposures in opposite directions can be offset. Calculated overall risks can be aggregated by currency in order to measure against currency risk limits as described below or for reporting purposes. Step 5. Document a detailed hedging policy. Risk management goals, risk tolerance guidelines, and quantified currency risks are the information one needs to prepare and implement a hedging policy. As FX risk management is usually a continuous process that involves multiple people over time, it is advisable to document specific areas in order to ensure a consistent and robust approach to hedging. Risk limits are key to the ongoing monitoring of the amount of risk that the business is exposed to. They are a quantitative measure that translates risk tolerances into practical pound sterling or dollar amounts and sets the numerical threshold which actual currency risks should not exceed. Target hedge ratios are another common technique to prescribe a desired amount of risk management. Hedge ratio is a percentage measure of overall currency risk that has been hedged and is particularly useful for longer-dated hedging, such as cash flow hedging. The world of foreign currencies is notoriously unpredictable. Hence, establishing basic principles or rules for hedging decision-making can help implement easy-to-follow procedures. How frequently should risks be reviewed? What actions are expected to be taken in certain conditions? If you plan to automate certain hedging activities, this is the time to define rules for future automation. In addition to risk limits, listing or defining criteria for permitted hedging instruments and counterparties is essential for avoiding unauthorized trading activity and the risk of fraudulent transactions. There is a vast range of complex and exotic financial instruments offered by banks and financial services providers. For most businesses, managing currency risks is a complex process, and finding an appropriate technology and systems to support manual processes is essential. While smaller businesses can initially cope with simple spreadsheets, many finance teams often find their needs outgrow the capabilities of Excel or Google Sheets. Historically, only enterprise-level treasury management systems had modules supporting currency risk management. Today, cloud-based systems such as HedgeFlows can also help growing businesses implement hedging strategies with the power of modern software. Step 6. Define responsibilities and controls. Below are typical contributors to an effective FX risk management process and their responsibilities. It is common to separate frontline and risk functions, such as Treasury Manager who implements hedging and the Risk Manager or analysts who oversee risks and the performance of the hedging strategy. CFO or Treasurer agree on risk tolerance with the board or the directors, supervise overall FX risk assessment and decision-making, and report results to key stakeholders, including senior management, the board, and auditors. Treasury Manager, often performed by a treasurer or CFO in smaller businesses, devises hedging strategy, risk limits, and the appropriate set of hedging techniques and procedures. She follows FX markets, executes hedging transactions and monitors, and improves hedge performance. Risk Manager identifies and quantifies risks, monitors performance and identifies areas for improvement, and prepares reports for senior management. Risk managers often serve as a second line of defense and report directly to the CFO. In some cases, a TMS or risk management system can automate risk monitoring and reports, helping the treasurer or CFO monitor risk and performance directly. Both treasury and risk managers may have analysts supporting them. Financial controller. Ensure compliance with relevant regulations and accounting standards related to FX risk management. Step 7. Select appropriate financial instruments to use. Different instruments offer varying levels of effectiveness, complexity, and cost. Let's explore the 4 main categories. 1. FX conversions and balances. This is the most primitive way of dealing with FX needs. It involves converting and maintaining cash balances in foreign currencies. This method is mainly suitable for managing payables. While it's straightforward, it can be expensive and may not cover all FX risks, making it a basic but limited strategy. 2. FX forwards and swaps. FX forwards are among the most popular hedging instruments for businesses. They allow you to lock in exchange rates for future transactions, providing a predictable cost structure. FX swaps, on the other hand, can help manage liquidity efficiently. They are particularly valuable when dealing with short-term funding needs across currencies. Consider these instruments for stability and liquidity management within your FX hedging program. 3. FX options. FX options provide flexibility, but come with additional costs, complexity, and less transparent market pricing. These should be used judiciously for specific purposes, such as protecting against unfavorable currency movements while leaving room to benefit from favorable ones. Employ FX options when you need tailored solutions, but be aware of the added intricacies. 4. Structured products. FX structured products combine various FX instruments into more complex offerings. They can offer unique benefits, but require a robust understanding to avoid hidden costs and risks. These products are often customized and should be approached with caution. Ensure that your team has the expertise to navigate these instruments effectively. By understanding and wisely choosing the right instruments, you can build a comprehensive FX hedging program that effectively protects your organization from currency fluctuations while optimizing costs and liquidity. Step 8. Manage and monitor risks and hedges. Based on choices made when devising hedging policy, a company may need to monitor FX risks continuously, or at least at regular intervals. The primary goal of continuous monitoring is to ensure that FX risk management strategies remain effective. Monitoring risk also ensures that exposures are kept within the risk limits, necessary decisions are made, and actions are taken in line with the hedging policy. Hedging strategy can be measured for its performance relative to the set risk management goals. As businesses evolve over time and market conditions change frequently, periodic hedge performance reviews are important for making adjustments to the FX hedging program as necessary. Step 9. Accounting and regulatory compliance. Depending on the size of the organization and hedging activity performed, additional accounting and regulatory compliance requirements may arise. While FX regulations are limited in most developed countries, adherence to FX regulations is a legal requirement in many emerging market jurisdictions. Failure to comply with these regulations can result in legal consequences, fines, penalties, and reputational damage. Hence, understanding and complying with FX regulations are essential to avoid legal issues. Compliance requirements may dictate the types of hedging instruments or counterparties that can be used, and understanding these rules ensures that the hedging program aligns with regulatory expectations. Regulations may influence how FX transactions are accounted for and reported in financial statements. Compliance with accounting standards ensures that the financial statements accurately reflect the impact of hedging activities. In the United Kingdom, accounting standards that affect hedging programs include International Accounting Standard 39 and International Financial Reporting Standard 9 or IFRS 9. These standards provide guidelines for how hedging activities should be accounted for and reported in financial statements. IFRS 9 replaced IAS 39 and introduced significant changes to the accounting for financial instruments, including the following. Hedge accounting. IFRS 9 continues to provide guidance on hedge accounting, but it introduces a more principles-based approach. It includes more flexible criteria for hedge effectiveness and eliminates the 80 to 125% rule used in IAS 39. Types of hedges. IFRS 9 recognizes three main types of hedges: fair value hedges, cash flow hedges, and hedges of a net investment in a foreign operation. It also introduces some refinements to hedge designations. Step 10. Measure effectiveness and improve. Your FX hedging program is essential, but it's not a set-and-forget strategy. Regular assessment and improvement are key. Here's a streamlined approach. 1. Monitor performance. Track how your hedging strategies align with your goals, looking at bottom-line impact and cost effectiveness. 2. Risk assessment. Continuously evaluate your FX risk exposure, adjusting your strategy to match evolving conditions. 3. Control costs. Keep a close eye on the costs of your hedging instruments, exploring cost-efficient alternatives when possible. 4. Compliance. Ensure that your program complies with accounting standards and regulations. 5. Stakeholder feedback. Engage with key stakeholders for insights and alignment with business objectives. 6. Scenario analysis. Test your program's resilience under different market conditions. 7. Training and knowledge sharing. Invest in team training and knowledge sharing to stay up to date. 8. Documentation. Maintain detailed records for transparency and regulatory compliance. By consistently assessing and refining your FX hedging program, you can keep it effective, efficient, and aligned with your organization's goals. To summarize, these are key steps for a successful, well-structured hedging program. Establish clear goals. Define objectives aligned with the overall business strategy and agree on risk tolerance levels. Identify FX risks. Understand and categorize different types of FX risks, including transaction, translation, operating, and economic risks. Quantify exposures. Identify and measure currency exposures to assess risk accurately. Document a comprehensive policy. Create a detailed hedging policy with risk limits, target hedge ratios, and decision-making rules. Assign responsibilities. Clearly define roles and responsibilities for key stakeholders in the hedging process. Continuous monitoring. Implement ongoing monitoring of FX risks and regularly review the effectiveness of hedges. Compliance and accounting. Adhere to regulatory requirements and accounting standards related to FX risk management. It's essential to recognize that the benefits of a well-structured hedging program extend beyond mitigating currency-related uncertainties. Such a program can also drive international growth, enhance financial stability, and boost competitiveness. By taking the steps listed above to construct an effective FX hedging program, businesses can not only safeguard their bottom line, but also position themselves for success in the ever-changing global marketplace. Don't wait for external events to dictate your risk management strategy. Take control now and reap the rewards of a proactive approach to FX risk management. Thank you.